UOB stock is up double digits this year, outperforming the SDI and catching investors' attention. But here's the big question. Is there more room to run, or has the market already priced in all the good news? In this video, we'll break down UOB's financial strength, dividend yield, growth outlook, key risks, and fair value entry price, all backed by data. If you're serious about investing in Singapore's top banks, this is one deep dive you don't want to miss. Welcome to Durian Finance, your go-to for sharp, SGX-focused investment insights. Today, we're examining United Overseas Bank ticker symbol U11.SI, currently trading at 36 Singapore dollars and 75 cents, up around 12% YTD, outpacing the SDI. Let's unpack if it's still a buy. Disclaimer, this video is for educational and informational purposes only. It does not constitute financial advice. Please do your own research or consult a licensed advisor before investing. Let's dive into UOB's financial performance over the last 4 years. In FY 2024, UOB's total revenue rose to 13.37 billion Singapore dollars, continuing its upward trajectory from 10.08 billion Singapore dollars in FY 2021. That's a compound growth of over 10% per year. Net profit attributable to shareholders climbed 6% YOY to a record 6.05 billion Singapore dollars, more than 48% higher than in 2021. This reflects strong earnings momentum and balance sheet strength. Basic EPS reached 3 Singapore dollars and 54 cents in 2024, compared to just 2 Singapore dollars and 38 cents 3 years ago, showcasing consistent shareholder value creation. Profit margin in 2024 came in at 45.2%, up from 39.5% in 2022, showing increased operational efficiency. UOB's net interest income remained stable at 9.68 billion Singapore dollars, while fee income and other non-interest segments posted 7% and 10% growth, respectively, highlighting its diversified income base. Operating profit was 8.22 billion Singapore dollars, marginally up from 8.15 billion Singapore dollars in 2023, and significantly above 2022's 6.72 billion Singapore dollars. On the risk side, asset quality remained solid with an NPL ratio of 1.5% and a CET1 capital ratio of 15.5%, up from 13.3% 2 years prior. Its loan-to-deposit ratio of 82.7% and liquidity coverage over 140% suggest ample funding and resilience. Finally, shareholders were rewarded with a full-year dividend of 1 Singapore dollar and 80 cents per share, reflecting a 50% payout ratio, up from 1 Singapore dollar and 20 cents in 2022. Bottom line, UOB has delivered strong, steady, and high-quality growth. A solid contender for long-term investors focused on both yield and capital preservation. Let's visualize UOB's business footprint through 2 key lenses, segments and regions. Starting with business segments. Wholesale banking leads the charge, contributing nearly 6.73 billion Singapore dollars or 45% of total revenue. Group retail, which includes mortgages, cards, and personal loans, add a solid 5.49 billion Singapore dollars or 36%. Other segments, such as treasury and investments, bring in another 1.37 billion Singapore dollars, while global markets rounds it out at 704 million Singapore dollars. Geographically, Singapore dominates UOB's pre-tax profit at over 64%, reflecting its core home market strength. Other Asia-Pacific markets contribute around 11%, with Malaysia following at 9%. The rest is split between global operations and smaller ASEAN markets like Thailand and Indonesia. This diversified spread shows UOB's stronghold in Singapore and growing regional presence across Southeast Asia. Let's close this out by asking, after this rally, is UOB Bank still a good buy? From 2019 to 2025, UOB's revenue grew a total of 46%, or roughly 6.5% per year, showing consistent and healthy top-line expansion. Even more impressive, net profit climbed 51%, compounding at around 7% per year. That's efficient earnings growth. Earnings per share hit an all-time high of 3 Singapore dollars and 54 cents, yet the PE ratio remains modest at just 10.4 times, cheaper than DBS. Its PEG ratio of 1.81 times suggests investors aren't overpaying for growth either. On valuation, the PB ratio is just 1.23 times, undervalued relative to DBS's 1.65 times, making it attractive from a book value perspective. The dividend yield stands at a solid 4.9%, with a sustainable payout ratio around 50%, giving the bank flexibility for future increases or share buybacks. Based on the Graham formula and assuming moderate growth and stable bond yields, UOB's fair value lands between 36 Singapore dollars and 38 Singapore dollars. The dividend discount model gives us a conservative fair value range of 28 Singapore dollars to 30 Singapore dollars. So what's a smart entry point? A margin of safety range between 26 Singapore dollars and 50 cents and 27 Singapore dollars and 50 cents seems reasonable for long-term investors. In summary, UOB combines growth, value, and yield in one strong banking stock, making it a great fit for patient income-focused investors. Now let's assess how UOB compares against its major peers, OCBC and DBS. On a trailing PE basis, UOB trades at just 10.42 times earnings, cheaper than DBS and almost on par with OCBC. Its forward PE is similarly attractive at 10.3 times, suggesting modest but fairly priced growth ahead. Where UOB really stands out is its PEG ratio. At just 1.81 times, it's the most reasonable among the three, meaning its projected growth isn't overhyped or overpriced. Its price-to-book ratio matches OCBC at 1.23 times, much more attractive than DBS's premium of 1.65. And in terms of revenue valuation, UOB shines with the lowest price-to-sales multiple at 4.33 times. Return-wise, UOB delivers a 12.57% ROE, better than OCBC and just behind DBS. ROA is also solid at 1.14%, still competitive within the industry. When it comes to dividends, UOB offers a healthy 4.9% yield with a conservative payout ratio of 50%. That's a balanced mix of income and sustainability. All in all, UOB is a strong middle ground. Cheaper than DBS, more efficient than OCBC in some areas, and with better growth pricing. It's a well-rounded pick for long-term investors seeking both value and stability. UOB is a well-capitalized and conservatively managed bank, but investors should be aware of key risks heading into 2025. First, margin compression is visible. Net interest margin slipped from 2.02% to 1.95% in Q1 2025. As global interest rate cuts begin to squeeze lending spreads. Second, credit risk is rising. Loan allowances increased 14% year-on-year, with 205 million Singapore dollars in provisions booked in Q1, hinting at growing caution in lending. Third, the regional slowdown remains a concern. UOB guided mid-single-digit loan growth, as weaker performance in China and ASEAN dampens lending appetite. Fourth, geopolitical instability, including U.S.-China tensions and unrest in the Middle East, could disrupt cross-border flows, especially for UOB's wholesale segment. Fifth, climate-related exposure persists. UOB has flagged its financing exposure to sectors like palm oil and fossil energy as areas of high environmental risk. Sixth, regulatory and ESG scrutiny continues to tighten. From AML rules to climate stress testing, compliance costs are expected to rise. Seventh, cyber and operational risks are non-trivial. UOB's push into AI-driven platforms and open banking increases its vulnerability to outages and security breaches. Lastly, FX volatility, especially in the SGD-USD and SGD-IDR pairs, could hurt regional revenue contributions. Despite these risks, UOB's strong liquidity, conservative provisioning, and diversified income base provide solid buffers. But vigilance is still key. Here's the bottom line on UOB. From 2019 to 2025, net profit rose 58% with steady revenue and dividend growth. At 10.8 times earnings and a 5% yield, UOB remains fairly priced for long-term investors. Valuation models suggest a fair value range of $28.30, with a good entry zone around $26.27. Final verdict. UOB is a strong pick for income seekers, offering stability, growth, and solid payouts. Like this video if you found it helpful. Drop your thoughts in the comments. And don't forget to subscribe to Durian Finance for more SGX stock deep dives.